Hi, welcome to this episode of the First Trust ROI Podcast. I'm Ryan Isakainen, ETF strategist at First Trust. For today's episode, I'm joined by Paul Black, co-CEO of WCM Investment Management, as well as Mike Trigg, the other co-CEO at WCM. I'm looking forward to this conversation very much. WCM actually sub-advises a couple of ETFs and a mutual fund for First Trust. First Trust distributes some of their mutual funds as well, but we're going to dig into what makes WCM unique. We're going to talk all about culture and how you can utilize that in screening companies and finding those diamonds in the rough in the international equity markets. Thanks for joining us on this episode of the First Trust ROI Podcast. Paul Black, Mike Trigg, I'm glad you guys were able to join us, and I'm especially glad we were able to make this work because I live in New York. It's cold and it's beautiful here in Laguna Beach. I don't know how you picked such a beautiful place, but anytime I get a chance to come out here, it's amazing. So thanks for having us.
Nice to have you here, Ryan, and it's very intentional. I'm sure we'll get into it later in the discussion.
So I'm intrigued by WCM partly because you guys have had really outstanding growth, and that kind of growth is pretty amazing in itself. But what's really surprising is that you're an active manager, and that's during a time when active managers just were hemorrhaging money, assets dropping for net outflows for most managers, and you're known for investing internationally. And as you know, international benchmark ETFs, as well as many international investments, have really lagged over that time period. So I guess my first question for you is, what are you doing that's different that has allowed you to get to the point where you are today?
Wow, there's a lot in that question.
And we can break it down further as we go here.
Yeah, from hey, internationals underperformed the U.S. for something like 15 years. Active managers are, going away if you believe the passive guys. It's not true. And, why have active managers underperformed? And it's all kind of tied up in this question of most active managers kind of do the same thing, expecting to get different results. And I often joke about it. Every manager that will sit across from you, when they tell you kind of philosophically what they're about, they will say, hey, we buy high quality businesses with strong competitive advantages, selling at a discount to intrinsic value. I mean, like 100 out of 100 managers will say that to you. And the truth of the matter is, if that's all you're doing, then you're not going to exceed the returns of the benchmark because everybody else is doing that. And there's a lot of smart people on Wall Street and a lot of smart people around the world competing using that same methodology. So all the inefficiencies are out of that methodology. And you will never underperform if you're doing exactly what every other manager in the world is doing. So, through our journey, you said we're at $100 billion and we were at $1 billion back in 2011. There's so much more to unpack in there because I often use this terminology that we right now look like that perfect family photo over the fireplace where everyone's beautiful, the dog's beautiful, the kids are clean, and nobody's fighting, and it looks perfect. Moment in time, WCM, $100 billion, probably the best global growth strategies on the planet, 100 people, 66 which own shares in the company. And the reality is we look beautiful now, but we haven't always been beautiful. And we've had a journey of learning what not to do by mistakes that we've made over the years. So we have iterated very aggressively over the last 20 years to find inefficiencies in the market that we can exploit that really I know other managers are not exploiting. And we'll dig into that more later. But you have to do something different. The reason we've had meteoric growth is because we truly are doing something different from everybody else. And in terms of the benchmarks outside the U.S. underperforming the U.S., it's true, but there are pockets of gold outside the U.S. There are companies that you simply must own. And in fact, those companies have performed outside the U.S. far better than the broader benchmarks inside the U.S. So you've got to be very selective. You've got to be specific. You've got to do something very different from everybody else. And all those attributes, from learning from failure to doing something different, has really led to our success.
So WCM, can you tell me a little bit what that stands for?
It stands for Why Culture Matters.
Okay. I want you to unpack that a little bit more because I've had the opportunity to hear you folks at WCM speak on a couple different occasions, and culture is one of the things that always comes out. That's something that you talk about a lot. First off, what does that actually mean? What is culture, and why is it important as you evaluate investment opportunities?
Yeah, I mean, culture to us is really a set of values or behaviors. It's how people act and behave. It's we like simply said, like it's how people act when the boss isn't looking. And we learned many years ago through our own trials and tribulations of running an investment management firm that the single most important thing we can do as leaders is focus on the culture of our company. And from that, there's a long story that Paul, that actually predates me, that Paul can go into. But this firm has been through, as Paul said, a pretty long journey. And there was a period of time when I don't think it had the best culture in the world, or a culture that one can be, really proud of. And through a lot of hard work and iteration, I think we've gotten the culture part right. And as we started to see some success, there was a bit of a light bulb moment where we thought, hey, culture's going to matter for WCM, and it's going to be the most important thing that's going to drive our success. It needs to be something that we also focus on in the investment process. And so when Paul was alluding to, I think what we do that's different, one of those pillars is the emphasis that we put on culture and finding companies with effective culture, because it's very difficult to quantify. It's an inefficiency that I think most investors don't exploit. And, it's something we've kind of lived and breathed ourselves. And then for the past 20 years, I think built a pretty robust investment process around.
So how would you describe the culture of WCM?
Well, we've got three core values that I would sort of think about it as, this is how we measure success. When we talk to new people, when we go through, our annual reviews with people, obviously we think about performance and accountability, but really at the end of the day, it's are they behaving in accordance with these three values? And they're pretty simple. They're gratitude, service, and fun.
I would reframe that to fun, gratitude, and serve others.
Yeah. I have just a slightly different perspective. To me, it starts with gratitude. I think everybody that walks into this place every single day feels incredibly lucky to be. I mean, I kind of fondly sort of describe WCM as a lily pad within the investment management industry. And I think everybody that comes here knows how lucky they are. And if that's the mindset that you kind of operate with on a day in and day out
basis, you naturally think a little bit less about yourself and more about others. And so I think a grateful heart, a grateful mind just naturally translate into behavior where you really focus on the other people around you. Like on the investment team, I talk about it all the time, and I say, just think about investment management. I mean, it tends to be an industry that brings a lot of self-interest and a lot of ambition and people wanting to climb the ladder, none of which is probably conducive to having really effective teams. And so if you can come to the office every day with this notion of gratitude, you're just naturally going to think about your team and everyone else around you. And I say, if everybody can just come in with that mindset and not worry about themselves, but worry about how they make every single person around them better, as a company, as a team, we're going to go so much farther, faster together. And when you can experience that environment, it is just ridiculously fun. When you work on great teams with people that really care about each other and care about each other's success, there is literally no one thing you can do more fun and work than living in an environment like that. So that's why he starts with fun. I start with gratitude, but I'm sure he's got a different way to sort of make that all sound sensible.
Well, that's debatable, but it's interesting when you think about those three core values: gratitude, serve others, and fun. They're nowhere else in the industry, right? Every other industry, if you say, what are your core values? It's going to be integrity, discipline, process, I mean, give me a break. Those are all permission to play. If you don't have those, you shouldn't even be in the game. So what we did about 12 years ago is we said, what really are the values that we live and that we care about that animate us, and let's enshrine them in the company. And to me, when as Mike said, if you're grateful, I would put a little different spin on it. If you have a sense of gratitude, then you acknowledge that we're very fortunate to do what we're doing. Yeah, we're allocating capital in a time and place where you're handsomely rewarded for it. It's an incredibly stimulating, intellectual discovery to try to understand the investment equation. But there's a lot of really good people doing it that work really hard. So gratitude should lead to, we're fortunate to be where we are, but we should have humility because we've been given a lot. And I think humility leads us to just be scrappy. Just be scrappy. We need to get better. We need to do something different. We need to be better than everybody else out there. So we are relentlessly trying to get better all the time because we've been given so much. And, the fun is the fun. If you love what you do, as Buffett said, you skip to work every day. You love it. I mean, tell me you're not going to give everything you got. But my favorite is the idea of serving others. We had an analyst come in. He was about 26 years old when we hired him. I mean, literally, this guy had PTSD for about a year after experiencing a highly toxic, brutal culture that was all about politics and positioning. And when he came here, he asked me, hey, how can I do really well at WCM? And I said, that is the simplest question anyone's asked me. If you can make everybody around you better, serve your team, serve the people you work with, elevate the team by making them better. Don't politic, don't position yourself for more money, don't position yourself for a title. If you serve everybody on your team and you elevate the whole organization around you, trust me, we will see you and you will be recognized. So when you think about my position and Mike's position as co-CEOs, our job really is to serve everybody in the organization. We get to do these podcasts and interviews and we get to be in front of people, but our main priority is making sure that our people have everything they need to be successful. And I don't just mean all the tools and all the different screens and technology they can use, but I mean, more importantly, are they in the position where they can prosper? That's what we spend our time doing. Do we have people in the right place? And frankly, are we aware of both the personal and the professional? And I think in business a lot of times you hear these really hardcore, hard-ass people say, hey, professional is professional, personal is a personal. I've never bought it. If I have a brutal fight with my wife in the morning and I come to work, are you going to tell me that's not going to impact me professionally and vice versa? So we work really, really hard on knowing the whole person. And what they might be struggling with at home or what they're struggling with here. But the more Mike and I can serve everybody and the more people in the organization serve everybody around them, I'll tell you, that is an incredibly powerful force that is almost impossible to compete with.
You said something interesting when you're talking about gratitude and you get to allocate capital. And it strikes me that the process of allocating capital is something that's virtuous. That's actually a good thing. You can help foster the growth of other businesses that are good businesses. And I think that's missing from the investment management industry. The idea that it's, not just going to gain for your investors, which is good, but there's actually some virtue in the process of allocating capital as well.
There's massive virtue. We talk about it all the time. One of the things that's really important to me, and I've been doing this 40 years, and people say, why do you keep doing it? And I do it because, one, I love it. I love the people around me, and I know that we're changing lives, to your point. So if we, I guess I can talk about a client, but one of our clients is St. Jude Hospital. They hired us about 10 years ago. If we do a great job and give them significant excess return over the benchmark, what does that do? That helps them spend more money to help children that have cancer. Firefighters, policemen, nurses, teachers. We talk all the time about, hey, this isn't just a mathematical equation about, and it's not just about us making money. It's about changing the lives of the participants that invest their money with us. And we constantly talk about that. We constantly reiterate how much by doing well and doing things differently, we can change the lives of people.
I'd add, I think, relationships matter a lot to us. I'm one of the things I think we're most proud of is a lot of the relationships we've been able to build over the years with clients, and in many cases, if they hired us in the early days when we were a lot smaller than we are today, they took a chance, and it's been obviously incredibly rewarding to reward them with that, and it's also incredibly devastating when you go through periods when you don't, because in many cases these people have bought in not just to our investment philosophy and our process and what we say that we do is different, but they've kind of bought into who we are as people and what the firm represents. And so you can't help but kind of carry that with you to a degree personally. And so he said it a million times. I mean, this is a great business. It's incredible when it goes well, but when it doesn't, there's nothing more devastating than having to deliver bad news to clients. And so we think about that, and we remember those. We don't forget about those periods where we haven't necessarily performed great. That's part of the business. It's part of market cycles and markets, but we carry that with us for sure.
Okay, so using culture as a way to evaluate companies to pick stocks ultimately, is there some sort of algorithm that you have that says this is how do you rank stocks based on their culture? How do you quantify culture?
Well, there's a few things there. I think, early on, I kind of look at, Paul alluded to this a second ago, but there's I think one of the reasons that we've been able to sustain the level of success that we have for, the last 20 years, call it, has been that, there is an iterative nature to our investment process. And so we have incredibly high standards for what good looks like, and we're constantly trying to push boundaries to get better at what we do. And I think our evolution around analyzing culture, I think, is a perfect example of that. When we first had that light bulb moment that I referred to, I think it was, okay, we recognize culture matters. We have a sense for what that looks like in an organization that's, call it people-driven, like investment management. Let's go try to find a lot of companies that, frankly, like might be places that Paul and I want to go work at, And so if you're looking at, the retail landscape, and I thought, okay, if I wasn't lucky enough to land on the lily pad at WCM and I found myself working in retail, like Costco seems like a pretty cool company. People there seem pretty happy as a customer. Like I love going there. Obviously they have financial and stock price results that stand out relative to their peer set. So okay, maybe we should go buy Costco. And so even early on it was easier in some respects because culture was not quite the buzzword that it's become today. And so if you could even just find companies and management teams that explicitly talked about culture, you kind of thought, okay, maybe we might be onto something here. But through that journey, we started to realize that there's a little bit of a self-selection bias that can come into that process, right? Because hey, what companies Paul and I might want to go work for doesn't necessarily. There's probably a lot of other great companies with great cultures that maybe he and I wouldn't last very long at. And so if you think about certain industrial businesses where scale and like a low cost structure really matter to relative competitive advantage versus peers, where those organizations have a lot of focus on numbers and accountability, and they can be stressful, difficult places to work. Maybe that's not where Paul and I would have gravitated to, but like, hey, there's a lot of companies out in the world like that are incredibly successful. So we had to sort of step back and say, really, what is we had this moment where we kind of just concluded, there is no such thing as a good culture. It's really, what is the strategy of the company? how are they going to differentiate and grow their competitive advantage versus their peers? And then do they have a culture, which again, as I said a second ago, is kind of a set of values and behaviors that actually makes sense for what that company is trying to do. And so we start with this notion of there's these, I call it sort of 3 pillars of our culture process. And the first one is this notion of culture strategy alignment, right? So understanding what is the strategy that company needed to generate great returns, differentiate themselves from their peers, and then do they have the right culture? So that's the first piece. And then the second one is we care a lot about the cultural strength, right? So how successful is the organization at galvanizing all of their people around that belief system or those values? So like in the case of WCM, I mean, I would be completely floored if you took anyone aside in this organization and said, talk to me about the 3 core values of WCM and why they matter and how they help you do your job, right? So we would hope, and that's what we do when we talk to companies. We don't just talk to the CEO or the president. We're talking to former employees, partners, customers, and all the employees that we can get in front of, and trying to understand, hey, is the stuff the management team's telling us about their culture, does that line up with what with what we're hearing from other folks? I mean, Amazon is a great example, I think, in this regard. And it's an incredibly, you can just Google articles about Amazon's culture and see all sorts of kind of stories that don't make it sound like it's necessarily the best place to work. It's very data driven. It's very it values data maybe over some of the softer sides of people. But if you ask any employee, like, what drives decisions there, it's low prices, convenience, and selection. And so, and convenience is a big one. And so, that's a high degree of cultural strength. And then the last one is we want cultures to be adaptable and to change. And so we want them to have a high degree of external awareness, to study best practices, steal good ideas from other companies. And so when we diligence companies, we're really trying to assess them across those 3 pillars. And then if they check all the boxes, then we'll conclude that, okay, this has a culture that we think is up to our standards of considering it as a potential investment. You need other things to get into the portfolios here, but those 3 things are how we kind of broadly think about the culture of a company.
And if I had to frame it a little bit, so it's cultural strategy alignment, so alignment between values and what they're trying to achieve, strength throughout the organization, as Mike said, adaptability. Those are kind of the 3 pillars. But the interesting part is, let's talk about First Trust. So First Trust, kind of has grown up with a lot of competitors around it. Why have you done so much better than every one of your competitors in terms of raising assets? We firmly believe in a pretty commoditized area, right? Pretty commoditized area. You know what the answer is? Culture. You guys have deeply embedded cultural values that animate what you do every day. So when you find that in an organization, that organization has a far greater ability of growing its competitive advantage because of how they treat their people and how they behave as an organization than a company that doesn't have as strong values internally to it. So, the interesting part is we are so deep into culture and believe so much that it actually it allows a company to grow its competitive advantage because of its people, that we have 4 full-time culture analysts. All they do is work on culture. They have different backgrounds from different experiences. They may not even know what a competitive advantage is. They've probably never done a DCF model. It doesn't matter. All they do, 4 of them, is work relentlessly on trying to understand the DNA of the companies we want to invest in. And here's to your earlier question, can you quantify it? 100% no. And that's the beauty, because, see, Wall Street doesn't believe anything exists unless they can quantify it. So they'll talk culture, they'll throw out, kind of the buzzwords. But if Wall Street can't measure it and quantify it and score it, it doesn't exist to them. And that's beautiful, because as long as they continue to believe that, we will continue to have a huge competitive advantage. What you're doing with culture is building a mosaic. And you build that mosaic over time. When we do work on a company, we have a pretty good idea of that alignment, strength, and adaptability. But I will tell you, like anything else, you learn as you go too. We get better and better as we own that company and see how it behaves in different periods of time. It was Walter Schloss who made a very honest. He's a long, 80 years ago was a great value manager, and he said phrases that money managers won't say. You really don't know a company well until you own it, right? You're supposed to know everything about a company, but the truth is when you own it and you see how it behaves. I'd say the same thing with allocators. Allocators that allocate to us or other firms, you don't really know the company well until you see their behaviors in difficult markets. Then you begin to understand, and it's either good or it's bad, and you can make judgments on that. So culture work, we have a huge lead. There's not anyone that's going to catch us in that because, again, people believe if you can't quantify it, it doesn't exist, and that's good for us.
So how often do you as you're analyzing companies, you find a company that the fundamentals look great, the growth trajectory looks great, and then you get to the cultural assessment and their culture doesn't meet what you're looking for, so you eliminate that. Does that happen frequently? And I guess the other side of that is, do you find companies that have great culture, but it doesn't show up in their fundamentals and you would maybe not choose to invest?
Yeah, I mean it's one part of the process, right? So yeah, it happens with great frequency actually that we find a company that we have a view on what it could do to improve its business, right? So we haven't talked about it yet, but the other really, I guess, sort of core part of what we do, and I think what's different about what we do at the bottom up kind of company analysis level is our emphasis on what we call Moat trajectory. So as Paul kind of said at the very, very beginning, most managers talk about trying to buy businesses with a sustainable competitive advantage or a wide economic moat. We learned a long time ago that it's not really the size of a company's moat that matters. It's actually the direction, and is that competitive advantage actually expanding and getting better? Strategy is a huge part of what enables a company to be able to do that. And so there's all sorts of examples that I can think of where we were just looking at a German healthcare company. It has three businesses. It has a pharma business, a life sciences business, and then a kind of a smaller kind of non-core operation. And we really want them to expand and invest in their life sciences businesses, and they're just unwilling to kind of just de-emphasize pharma. That's kind of what the company's known for. And so, the strategy to us is quite clear of what the company should do to create value. But when you go in and you do all the culture work, you realize that there's just no chance that the organization's gonna get there. And so, that would be an example of one where, hey, we liked the idea of how this company could improve its moat, but just didn't have the culture to back it up. And then, I mean, on the flip side, I think if we just went and bought 35 companies with great cultures and didn't pay attention to competitive positioning, moat trajectory, valuation, I mean, I don't think that the portfolio would be set up for success. And so it's part of the puzzle, but it's not the only piece.
So another phrase that I've heard as I've listened to WCM and read some of your materials is this notion of defy the fade. Talk to me about defy the fade. What is that, and why is it important?
Well, we talk about, I mean, I think about it, frankly, with our own business as well as how we invest, but it does speak to moat trajectory and culture. And so if you just think about basic finance or economic theory, every business, should be mean reverting over time, right? Companies can have a period of success where they grow, they deliver outsized returns, and then eventually, that success attracts competition, and then their performance, be it financial or stock price, becomes pretty average. And what we've discovered through successes and mistakes is that businesses with these two attributes that we were talking about, positive moat trajectories and cultures that are very well aligned around the strategy to grow that moat, those are the companies that are gonna defy the fade. And so it requires a slightly longer time horizon. I think Wall Street's decent in most cases at getting the next 12 months right. I think a lot of the inefficiency or the arbitrage that we're exploiting is thinking about these things in a slightly longer term time frame. Culture is not going to matter day to, month to month in terms of, how a stock price performs. But over a longer time period, 3 years, 5 years, 10 years, or longer, it is the ultimate, difference maker. And so we use that defy the fade term to kind of express ultimately what these two things are helping businesses do. And you see that also in just the forecasting errors that take place oftentimes on Wall Street, because typically they're not incentivized to think about what's going to happen over the long term. They're trying to get their earnings estimates right over the next 12 months. They've got armies of analysts that are just working spreadsheets and trying to get that EPS number right every single quarter. There's a lot of hedge funds and pods and people that are trading around all that information. And so if you look at most of the great investments that we've had, Wall Street's like, okay, let's say a business is going to grow 20% next year. Oh, okay, Wall Street's pretty good about getting that right. And then they say, oh, well, can't do that 2 years in a row. So probably do like 18, and then it's going to go down to within a few years it's down to say 10% growth, and that they're kind of modeling that fade, so to speak. And it's the businesses that have these moats that are growing and these cultures around them that just time and time again can exceed expectations and sort of did not defy that inevitable fade. And it's that delta between like the mean and what the company is able to perform that generates all the alpha in the portfolio.
Finance people, to Mike's point, most finance people, wherever they are in the world, worship at the altar of the DCF, right? The discounted cash flow model. They worship it. And especially if you're young. The younger you are, when you come in the business, everyone teaches you to do a DCF. They think there's something magical in there. But it takes them a while to realize there are probably 100,000 people building a similar model to what they're doing. And they tweak a couple of numbers here, they tweak a couple of numbers there. And as Mike said, what they typically do is say, hey, this company can't grow that rapidly for that many years. So after a few years, they kind of fade their guesstimates to GDP growth out 10 years. And again, what I like to say this a lot, show me a DCF model somebody did 5 years ago, and I'll show you how wrong it is, inevitably. Because with these great compounders, with these companies where we are mostly right about the economic moat or the sustainable competitive advantage growing, with a culture supporting it to grow, they will defy that fade. They will defy that overly conservative model. So again, as long as Wall Street thinks it's about the numbers, we're going to win.
How much do you pay attention to some of the macroeconomic, some of the external sort of criteria that others might look at when they're allocating? Also, like geopolitical issues. A lot of what you do is in international stocks. Do you pay much attention to macro or geopolitics?
Mike will have probably a different take on this, but I will tell you that every time we've become concerned with macro issues, whether it's geopolitical, interest rates and environment, GDP growth, we've mostly been wrong. Concerned about Taiwan or China invading Taiwan, and therefore what? You shouldn't own Taiwan Semiconductor because of that geopolitical concern. There's a lot to go into there. Concerned about the Mexican peso. Wherever we've acted kind of with a macro bent, we've pretty much always been wrong. So we try not to do that.
It's funny. I just for an institutional consultant just got asked a question about process improvement, and we have a journaling app that we developed internally where we document all of our, not just, it's really about any view we have on a company, but it starts with all the transactions that we've made in the portfolio. And we talk about, why we bought them, when we sell them, we document the reason that we sold, and there's different tags in there. So if it's, there's a description, but we also might say, well, the macro was one of the reasons that we sold. And so if you go back over 10 years ago, there was, I think, maybe 4 or 5 decisions that we made that had macro as one of the influencing factors for the sale. In the last 10 years, we've had just a couple, and they've actually proven to be not the worst decisions. And so we use a lot of, Paul talks about macro, but we use this journaling app to actually embed these lessons in our mind so that we don't fall into the trap again, and actually repeat the same mistake twice.
Now, having said that, the macro does matter in emerging economies. It really does matter. What's going on. That's something we learn, but less so in the developed countries.
And I think I think about it on the. I think when macro's bad, I think we look to lean into it because it tends to overshoot to the downside in terms of how stock prices perform. So, in that sense, I do think about it. We don't make macro predictions. We don't let macro predictions, good or bad, influence decisions we make with companies. And the same would be true for. I mean, the geopolitical stuff is just incredibly unknowable. But I could say I have just a house view that there's going to be more instability around the world in the next 10 years than there has been historically. I think that's pretty irrefutable at this point, especially with 2 wars going on. And so if you think about the behavior changes that are taking place in Europe and Asia around defense, are defense companies thematically a pretty good place to be right now, knowing that, NATO's starting to step up. You've got more countries joining NATO. You've got countries in Asia that, like Japan, that are increasing their defense budgets for the first time in decades. Yeah, so we don't. So do I have a geopolitical view on what's going to happen in China and Taiwan? I just witnessed a circular conversation about that a couple of days ago. Nobody has any clue. But I know that people are worried about it, and that means that there's going to be probably more spending on defense, and that's probably a place we want to invest.
So one of the things that you, Paul, said towards the beginning of our conversation had to do with the reason why people should even consider stocks outside the U.S. Because, if you talk to a lot of the financial professionals that we talk to, they've gotten a little bit discouraged by a decade of underperformance, especially for those passive international benchmarks. Yeah. So as you guys are talking to your clients, what are some of the reasons that you maybe refer to as you're thinking about why you should look outside U.S. markets?
Well, the first thing I'd say, try to say this kindly, but it's complete foolishness to index international markets, and it's complete foolishness to index EM in particular. Because most of the index in EM is made up of really junky financial companies, a lot of natural resource companies. Yeah, if that's what advisors are doing, they're saying, I don't really know EM, so I'm going to index it. You've just created a massive headwind for yourself.
Yeah, I mean that's how I was going to answer the original question about how we've kind of done what we've done. I think these international benchmarks are pretty inefficient. There's a lot of bad companies in them. But I think that there's also some amazing companies, and if you can find them and you can own them in a meaningful way, like in our case, all of our portfolios are fairly concentrated, right, between, say, 30 and 40 positions. They look really, really different than the benchmarks, and I think we've just proven that despite all the passive versus active stuff, that if you want to take a differentiated view on A, how you look at companies, but B, also how you construct your portfolio, there's active management is alive and well and not going away, and anybody that tells you different is just telling you lies.
So Mike, one of the reasons why people have often maybe pitched increasing allocations to international or even just rebalancing to your portfolio in international is because of the valuation differential. The fact that a lot of the indexes have really low PE ratios or price to book ratios, especially in comparison to U.S. stocks. In your opinion, is that one of the best reasons to invest internationally, or how does it fall in your list of reasons that you would consider international investments?
You're going to laugh, coming from an international focused, portfolio manager, but I think that that's actually a total nonsense. It's interesting because it's we're kind of approaching the end of the year, and all sorts of people are publishing their, kind of their investment outlooks for next year. And there are a few slides I've seen a couple times that show this, kind of once in a decade dispersion between, U.S. market valuations and non-U.S. And that's not how we think about it. And that's not why I think it makes sense to invest internationally. Some of those just to frame it. I mean, most of those charts or that data that people see is looking at the broad-based benchmarks, right? And I think if you're not familiar with international benchmarks, you probably don't realize that they're incredibly inefficient. They're pretty easy to beat, and part of it is because there's just a lot of bad companies in them. There's a lot of European banks. There's a lot of kind of commodity-driven, mining-driven, emerging market companies in there, and they're not businesses that we would ever consider investing in because they don't look like they're going to be a ripe source of excess return. And so I think the reason you invest internationally is to actually get access to, those few select winners that are out there. And then I think, we've proven over time that we can find them through our Moat trajectory and culture framework, and then own them in a concentrated way, that allows us to outperform those benchmarks over time. So there's a diversification benefit from what you're going to find in the U.S., but also just like some really, really incredible companies. I mean, if you think about, Taiwan Semiconductor, just to use, an example, I don't know why anyone wouldn't want to have exposure to that company. You think about everything that's going on in the world right now with artificial intelligence, and right now there's this new debate about, obviously NVIDIA's done incredibly well. It's been a huge contributor to U.S. benchmark returns, but now there's these, alternative chips that, Amazon may be developing, or Google's TPU, and it's a very difficult call to make on what's going to happen over the next 5 years. Well, guess what? Guess what's the easiest way to play that? The one company that makes all of those chips, no matter who it is, right? And so, TSMC, to our mind, is actually probably one of the most important companies in the world, if not the most important company in the world. And as an investor, as someone that's trying to allocate money for clients, you want exposure to companies like that.
So I've done this a long time, as I said earlier. And what is it? For the last 15 years, people have been playing this, international and EM. How many times have you heard, EM, it's far cheaper than the Western world, and it's growing much more rapidly. And you know what? There's this whole emerging middle class coming up that's going to spend more money. 15 years. And what happens? Well, kind of like in general, if you buy the benchmark once every 15 years, you get a huge spike in returns, and the rest of the time you get nothing. Now, the truth of the matter is, Mike said, and I'll just be a little more blunt, the EM indexes are trash. The international indexes are trash. As Mike said, do you want to own a European bank? The reason the PEs are low is because it's like, 30% banks that are selling at single-digit PE ratios and a bunch of industrials. And then, that's why it's cheap. So forget the index argument and realize that there are about 100 brilliant companies that are outside the U.S. That's kind of, 100, 150. That's the field we play in. And those companies are, a lot of them are must-haves, like Mike just said about Taiwan Semiconductor. If you're just U.S., you've missed one of the greatest runs and one of the greatest companies in the last 20 years. So, it's not really an international U.S. argument. It's just buy great companies no matter where they are, and that's what we do.
So if I were to paraphrase, what I'm hearing you say anyway is that you shouldn't necessarily allocate to international benchmarks, because what you end up with is stocks that are cheap, that are probably going to stay cheap because the business model is antiquated or has some regulations and the European banks that might hold them back. But you should allocate internationally because of the opportunities that you look to invest in.
It's kind of lazy to allocate to the indexes internationally. It's kind of lazy, and you're really doing a disservice to your client.
And even, it's not just the indexes. It's these closet index funds that claim to be active, and it's ETFs that have some country dynamic to that, or that you think you're getting international exposure through some 125 stock strategy, whether it's active or an ETF. It's you gotta if you want to produce differentiated results, you gotta have a portfolio that looks different than the benchmark, and you can do that from finding great companies and doing it in a concentrated manner. And I think that's especially true now. I'm not going to make a market prediction by any means, but obviously, the U.S. markets have had an incredible run, and it's in part been driven by, a small cohort of companies. I think there's going to be probably a different set of winners in the next 10 years. Not to say that some of those companies still won't do extremely well. A lot of them will be in the U.S., but there'll definitely be continuous examples of companies outside the U.S. That will show up. The next Mercado Libres, the next Sea Limiteds. That'll.
One of the greatest companies in the world is Ferrari. It's not in the U.S.
It's a great example of a non-U.S. company with obviously an incredible brand and one that's proven to defy the fade over time, right? There's a waiting list. They continue to create aspiration around the brand with new models. In many cases, if you want the highly aspirational model to get up the right part of the list, you have to buy pretty much everything else on the list. And they've got SUV coming. They've got an electric and hybrid vehicles coming as well. And their Formula One team's not doing too bad either, which I think helps the brand as well.
Sure. All right. So this is a question that I've started asking people that I've gotten some really interesting answers. So I'm going to ask you guys as well. Paul, I'll start with you. You mentioned that you've been in this industry for about 40 years. Okay. So imagine you didn't go into this industry. What do you think you'd be doing right now?
I love that question. I ask that all the time. I love to ask people, if you didn't have to make money, what would you do? And when we hire them, right? And of course, what I want to hear them say is, "Oh, I'd do what I'm doing now. I love investing," right? But a lot of them will say, "Well, I'd open up a kennel, or I'd, some kind of thing like that." It's like, well, why don't you just go do that? So, without question, I would be in real estate development. It's the two. To me, the two most interesting businesses in the world the first one's what we do. But if I wasn't doing this, I'd want to keep allocating capital, and I love the idea of developing real estate because you can unlock and create an immense amount of value for clients on that. That would definitely be what I'd be doing.
Mike, what about you? What would you do if you weren't in the asset management industry?
I would either want to be an offensive coordinator for an NFL team.
With the Kansas City Chiefs, maybe?
Well, yeah, it'd be nice to have Mahomes. On a team with a good quarterback.
Are you a Chiefs fan?
I am. Yeah, I'm from Kansas City.
More than a fan.
Or I would want to be, like the general manager of a baseball team. I like competition. I like finding inefficiencies in how it's sort of like to me it's another way to express the things I like about investing in a different way. So I like exploiting inefficient ways of people thinking about, what a player may be worth or how the market may be interpreting him. I like trying to find the idea of finding a weakness in a defense and then devising a scheme, to go score a touchdown or, to have a set of plays that'll take advantage of that. That, to me, that would be, imagining me, up in the booth at an NFL game, calling plays for any NFL team would be super fun. But I like it because it's the things I would like about that are the things I really like about, investing and honing an investment process and trying to make it better and trying new things. And, you try a play and the quarterback would get sacked. Oh, that was a stupid play. We better iterate on that. That type of thing sounds like a lot of fun to me.
I was a highly successful flag football coach for about 8 years.
Yeah, I did go to, I can attest to that. I've been to a couple of those games. Yeah.
But you know what? But to illustrate what, I'm a really good coach, but you know what? Talent. It's all about talent. Same thing in this company. It is all about talent. I've had discussions like, okay, let's talk about the Patriot way. Oh, it's all about the Patriot way. It's all about Belichick and the Patriot way, and do your job. No, we've all found out it wasn't about the Patriot. It wasn't about Bill Belichick or the Patriot way. It was about Tom Brady. It was about raw talent that elevates everybody else. To me, that ends the argument.
Okay, so my last question for each of you. So viewers of the podcast, what should they be reading? What have you read recently, or what would you recommend?
Well, I'll tell you what I would definitely recommend you don't do. Don't read the news. Don't read any short-term, don't listen to the news, don't watch the news, shut off CNBC, just turn it off. That is probably, those items are absolutely the most detrimental to trying to create wealth long term, because all they're about doing, and I don't care if it's Fox, or CNBC or MSNBC or CNN or anyone, they're just trying to create chaos. Right. So and so the more you get, and even reading the paper every day, it's just chaos. So the best thing you can do, in my mind, and it's what we did 25 years ago when we bought the firm, is read the classics again, read them again and again and again. So of course, Intelligent Investor, you read margin, just read the 2 chapters on margin of safety and Mr. Market. That's a for sure. I mean. And then you got to buy, Buffett's favorite book after Intelligent Investor is Common Stocks and Uncommon Profits. Read that by Phil Fisher. Read that book cover to cover. Do it a couple of times. You got to read you should read all the letters of Warren Buffett. There's just gold in there. Who I've dug up some really archaic pieces of chapters from John Maynard Keynes. He's mostly known as an economist, but the guy was a brilliant investor. He's got a couple of chapters on how to invest properly, which is in a focused fashion, fewer rather than more names. And then I would recommend a book by Lawrence Cunningham that he wrote called Quality Investing. It's very similar. It's written about a firm over in London, but it's very similar to what we do every day. And I think if you just read and reread those books, and they all have common themes in place, and you take them in, you're going to learn to be a very good investor.
Anything outside of the investment industry that you would recommend reading?
Love biographies. I can't remember the last one I read. Franklin Roosevelt I just read recently. I read one on Reagan. I've read a lot on Winston Churchill. I love to see how leaders led in difficult times.
Mike, what are you reading these days? What would you recommend?
Well, there's a book Paul just reminded me of that I recommend sometimes. It might even be free, believe it or not, which I don't know if that's a good thing or a bad thing. But it's actually called The Emotionally Intelligent Investor, and it's. I'm a big believer in the importance of self-awareness in all things in life, but I think it's particularly valuable in investing, and emotional intelligence is kind of another way to sort of express that. And so this book talks about that in some detail and different ways that you can be more understand your biases better, and then tools that you can, and also understanding how the market's actually interpreting companies and situations, and then it gives you actual tools and ideas like journaling as an example to get better and become more aware of your strengths and weaknesses. So I like that book quite a bit, and it's pretty short, so that's an easy one. It's written by an old Soros hedge fund guy who now has a small hedge fund. That's a good book. I'm reading a book right now that I'm not done with, but it's called Tin Cup Dreams, and it's about the golfer Esteban Toledo, who I recently played golf with, and he's a guy that's from Mexicali, Mexico, and was able to basically earn his way onto the PGA Tour despite having literally nothing. So that's a pretty cool book, and then. We're actually in our library right now, so it'd be easy for me to just kind of scan the some of the books on the shelves. We like the book Creativity Inc. By Ed Catmull. That talks a lot about it's a story of Pixar basically, and I think particularly in investing, I think the power of creativity, whether that's just taking like a more optimistic view on a situation or trying to sort of understand how the market may misinterpret situations, I think is pretty powerful. So how teams can function well and be creative, I think and think about things different than other people. I think that's a pretty fun book to read. And then I think history-wise, I'm kind of intrigued by studying World War I right now, because I think there's some bit interesting parallels to maybe what's going on in the world right now to kind of conditions on the ground, kind of pre-World War I. So I just started a book actually this week about that. So those are a few things that come to mind.
All right, final question. Looking forward the next decade or so, are you optimistic or more cautious? I won't use the word pessimistic.
Well, it's a bad question for me because I think optimists rule the world. And I think if you live your life from a position of being optimistic, you're going to have a much more successful, rewarding life. So, again, I'm extremely optimistic. I'm very I'm kind of like from a broad market side, very optimistic about the U.S. From company specific sides, there are so many great companies that are developing around the world that we're going to be a part of. And again, it's almost impossible if you unleash people's creativity and their ability to take risk, what they can do. And so overall, next decade or so, it's hard to see that you're not going to get good returns.
There's not a whole lot I can add. I would. It's funny. We just went through a kind of a website kind of rebranding process, and we're trying to kind of connect some of our values to different things that we hold true. And I made the observation at one point that I think gratitude does lend itself to a degree of optimism. I don't know many people that are really grateful people that think the world's coming to an end. I mean, most people I know that are really grateful are happy people that look at the situations with positive intent and glass half full perspective. And so it would be insane for me to actually sit here and talk about how grateful we are and then answer that question by saying that I'm at the same time pretty pessimistic about what the world is going to look like in the next 10 years. I believe in the power of people, and whether that's in the U.S. or people that are living and creating companies anywhere in the world, we all kind of want the same basic human things, and I think that's going to lend itself to a lot of incredible companies that are going to be born in the future, and there's going to be just great opportunities to invest in them.
All right. That's a great place to leave the conversation. Mike and Paul, thank you for joining us on the podcast, not only because it gave me an opportunity to come to Laguna Beach in December, but because it's been a really interesting conversation. But thank you very much.
Thank you, Ryan. Great to be here.
And thanks to all of you for joining us on this episode of the First Trust ROI Podcast. We'll see you next time.